This webinar is intended for informational purposes only. So we will just some general information before we get started. If you have any questions, feel free to enter them in the chat box. And we will address questions after the presentation is over. If you weren't able to join us this afternoon, we will send a copy of the slides as well as a video of the presentation. Today, what we're planning to cover is talking about developing an overall plan, different types of equity compensation you might receive, a little bit about employee stock options, restricted stock units, and also some discussion around planning and risk management. So as I mentioned, I'm Paula Nangle with Marshall Financial. I am a certified financial planner, president of Marshall Financial, and also a senior wealth advisor. I spent the past 15 years with Marshall helping executives and families navigate questions like, what's the smartest way to manage my equity-based compensation? Drawing from my corporate experience and also my passion for personalized financial planning, I help specialize in helping clients simplify complex decisions and move forward with confidence with their future. I always like to say our ultimate deliverable is peace of mind. We help professionals like you plan for today and the road ahead. So when we look at equity compensation and bonuses, this is a time of year when a lot of employees are getting bonuses. They may have equity compensation that is either being granted or vesting. So it's a great time to kind of step back and take a look at your overall financial picture and do some financial planning. With some thoughtful planning, you can really help you focus on achieving both short-term and long-term financial goals. It's an opportunity to build your wealth and improve your quality of life. We at Marshall believe that having a solid financial plan in place can give you peace of mind and help you live a happier, healthier, more productive life. The other part of that is also looking at the resources you have available and how do you best use those resources to support the life you want to create. So at Marshall, we take a very holistic approach to financial planning. We find that when you're focused on what's important to you, your values, what your vision is for your future, and how you can utilize your wealth to support all of that, can really help build wealth over time and support your goals both today and into the future. So as you can see from this picture, there's a lot of different components that go into financial planning that we take into consideration. But today we're going to focus mostly up on the right-hand corner there with career and compensation. And if you think about it, your ability to earn a living for a lot of people is probably one of your largest assets that you have and making it work for you. So let's delve a little bit more into compensation and the benefits that go along with that. So I guess jumping back to financial planning, now is a good time. Now, if you may be having a liquidity event, now is a good time to kind of take a step back and assess what's your current situation. What's your net worth? And on this slide here, we show an example of, this is a fictitious couple. They've got investment assets of $735,000. And of that, $525,000 is in their employer retirement plans, 401k plans. And they also have an investment account, a brokerage account of about $180,000, as well as some college savings for their children. Other assets include their home, which is valued at $1 million. And then you get down to, it says employer awards, and those are valued at over $1.6 million. So they've got significant assets at $3.3 million, but they also owe some money on their mortgage. They have a liability of $480,000. So their bottom line net worth is about $2.8 rounded up to 2.9 million. Well, when you take a little closer look at that, you look at that line where the employer awards are, that is more than half of their overall net worth. So that's what we often refer to as concentration risk. So you've got a lot of equity tied up in possibly one or two company positions, assuming this is a couple and both couples have equity compensation from their respective companies. Generally, once you're over 10% or more in a single individual investment, that's considered a concentrated position. So it's good to understand where you are and how to best move forward. So if we look at total compensation, so here's an example of a total compensation package. You may get a base salary of about $400,000, target bonus of $250,000, target of equity awards of $400,000, some other company benefits valued at $50,000 for a total compensation package of $1.1 million. So those are substantial assets to work with. And it's a good time, again, to take a step back, understand what is your total compensation and how are you allocating those resources to support your lifestyle. Are you covering your overall basic living expenses with your base salary, or are you using that bonus money that you get every year to fund your basic living, or are you allocating that towards one-time goals and future goals so it's a balance, enjoying your life today while also planning for the future. The other thing about the bonus and the equity, those are target amounts and aren't necessarily guaranteed. So there could be some variability in the actual value you receive. So delving into equity compensation, so this is typically non-cash pay offered as part of your total compensation package. And typically we see a split between stock options and restricted stock offerings. You may get one, you may get both, you may get neither. But so there are a couple different types of stock options. The most common ones are non-qualified stock options, or NQSOs. And there's also incentive stock options, ISOs. So the biggest difference is the tax treatment of those two types of options. And then there's restricted stock. So there's different flavors of varieties of restricted stock as well. RSUs, restricted stock units, or restricted stock awards. There could be performance stock awards that are tied to meeting certain company goals. So we're going to focus on, there are other types of equity compensation, but those are the two that we're going to focus on today. So if we take a look at stock options, so basically what a stock option is, it's a grant that you would get from your company, which gives you the right to buy company shares at a fixed price. When you get your award document, it'll have a date on it. It'll tell you what the exercise price is. So that's the price at which you are eligible to buy shares of the company. It'll tell you what the type of option is, whether it's a non-qualified stock option or incentive stock option, the number of shares that are granted, the vesting schedule, and the terms of that vesting. So what we typically see here is maybe like a 3-year graded vesting schedule where a third vest every year over 3 years, or it could be 25% over 4 years. Sometimes you'll see a 3-year cliff vesting, which nothing vests for 3 years, and then on the 3rd year, those options vest. So it's important to understand what you have in that option award. And then there's also an expiration term. What you typically see is about a 10-year expiration date. So it gives you time to exercise those options. Along with the grant, you should have a plan document that will tell you what happens if there is an impact from job events, such as What if your company is bought or sold? What happens to your stock options? What happens if you leave the company? What happens if you're terminated? So there are often different treatments of your options depending on those events. There's also impact of life events, could be death, disability, retirement. So when you're planning, as part of your plan, it's important, especially if you're planning a transition, to understand what those nuances are of your options. So let's take a look at an example of a stock option. So this employee last year received a stock option grant in February of 2024. It had a strike price of $125 a share, and the grant was for 1,000 shares, vesting 33% a year over 3 years. Jump ahead to 2025, they hit that first vesting period, and now that means they're vested. That means you have the ability to exercise. It does not mean you have to exercise. So let's take a look at two different scenarios. In the top there in scenario one, all right, in February 2025, the market price is $85 a share. So your stock option is basically worthless. It's underwater. So you could go out on the open market and buy those shares of the company for less than your option allows you to buy them. Scenario two is what we hope for, that the market price of the share is higher in subsequent years. In this scenario, the market price is $156 a share. So each share has gone up $31 a share. You multiply that times the 333 shares. So that has a potential value of a little over $10,000. So you could exercise that option, and then if you did exercise it, that bargain element or the difference between the strike price and the market price, that $31 a share, that amount would be taxable upon exercise. And that is taxable as ordinary income. So you'd pay all the taxes like you do on your ordinary income. You know, you pay federal, state, local, and other payroll taxes like Social Security and Medicare. So once your options are vested, you've got, you have, as I said, you have some options of what you do with your options. So you have options with your options. So one option would be, assuming they're all vested, you could exercise those options and actually buy the shares of the company stock. Any bargain element that we discussed before would be taxable when you exercise them. So if you're buying the shares, so now you're taking possession of those shares of stock, and with the hope that it will increase over time, but there is the possibility it could decrease. And so depending on your other holdings, by adding more shares to your portfolio, you may be adding to an overly concentrated stock position. So something to be aware of. So you can actually buy the underlying shares. You can also do a sell to cover, where you're basically taking the profit as shares. More frequently, what we see is people do a cashless transaction where you buy all of the shares and sell all of them at the same time. And so you're basically taking the profit in cash, and there would be withholding for those ordinary income taxes from that, the bargain element between the market price and the strike price. So in that last case, it was $31 a share. The other option is you do nothing and hold them for a future date. And that's where some of the planning comes in. What's the best option for your particular situation? And then let's look a little bit more closely at restricted stock grants. So these are a little bit different, a lot of similarities, in terms of the grant document that you would get. It would have a date. It would tell you how many shares you're getting. Again, the vesting schedule. Often you see the same if the same company, same vesting schedule for options and restricted stock. And then again, the plan document would tell you what happens upon specific events at the company. There are two main types of restricted stock awards that you might get is restricted stock awards or restricted stock units. RSUs are the ones that I have most commonly seen, but there are situations where you get actually awards, and these types of awards allow you to do what they call an 83B election. So this is something where you say, all right, you got an award for, you could buy 1,000 shares of a stock at $10 a share. So you could elect with this 83B election to recognize that income in the year that the stock was awarded, so that $10,000. And so you would be taxed, say, in 2025 when you got that award. And then in the future, if you sold those shares, it would potentially be taxed as long-term capital gains as opposed to ordinary income. There are some rules around that filing, and so it's good to have some assistance in preparing that. But more commonly, you see restricted stock units, which don't give you that optionality. So we'll take a look at an example of a restricted stock award. So in this case, again, last year, the employee received a grant in February for a market price at that time was $125 a share for 1,000 shares, which vest 33% over 3 years. So now it's February 2025, 333 shares vest. And when those shares vest, that is realized income to you, regardless of what you do with the restricted stock that's now yours, basically. So using the same pricing as the option scenario, market price a year later is $85 a share. Those 333 shares vest, and that has a value of $28,000 roughly. That is taxable as ordinary income to you. Scenario 2, the price went up. In this case, you've got a taxable income amount of almost $52,000. So either scenario, whether the stock price goes up or goes down, you still get a value that is taxable to you upon vesting. So that's probably one of the key differences to be thinking about when you're thinking about restricted stock versus options. Options, if you don't do anything, they're not going to be taxable income. So there's opportunities for tax planning there. Whereas with RSUs, once they vest, it's a taxable event to you. So then the decision is, what do you do with those shares? Do you, hold them or do you sell them? So again, when those restricted stock grants vest, this is upon vesting, that is considered ordinary income to you, and all the payroll taxes apply. Most typically, you'll see shares are withheld to cover most of the taxes. And this is where I have seen over the years where you can get surprised. So maybe the default withholding on those grants is 20 or 25%, but you're in a 35 or 37% tax bracket. And so you've had under withholding on those, that value of the grants that vested. So it's good to understand what your tax bracket is, what your tax liabilities are, and plan for that so you're not surprised. So with vested RSUs, you can either continue to hold the shares and hope that the price may increase, but it may also decrease. And again, you have the risk of adding to an already concentrated stock position. That may or may not be the case. Another option is to sell all the shares. This is literally part of your total compensation package. So you can use the sale of those shares to add to a diversified investment portfolio. Downside is maybe you'll miss out on some future appreciation, but perhaps you'll miss out on some market downside. And the other option is do some combination. Depending on your position, you may be required to hold a certain number of shares. So it's important to understand what the rules are for you and your particular situation. So I mentioned concentration risk a number of times, and this slide really is a visual, hopefully give you a somewhat of an understanding. So if we look at the yellow dot towards the left side of the slide, that is the S&P 500 index. And this is looking at a 10-year look back from January 2015 to January 2025, what the average rate of return is and what the variability or the standard deviation of those returns on a monthly basis is. So the S&P over that time period had an average return of 13.8% with a variability around that range of 15.6% plus minus either way. So, with reward, you'd have to take the risk that goes along with it. If we look at, say, the Amazon up in the top middle of the chart, you see it had much higher return, but also much higher standard deviation or variabilities around those returns. So if you've got half of your net worth tied up in a single position that's fluctuating up and down 30%, it could lead you to have some uncomfortable feelings. It's really a matter of your risk tolerance and how much risk you're willing to take. If you look down towards the bottom of the page, say you worked for Disney and had a bunch of Disney shares, your annual returns or average returns would be about 3% with about the same amount of volatility as the Amazon stock. So something, that's why we talk about a diversified portfolio. You see each of these individual stocks had significantly higher, with the exception of the Coca-Cola example there, volatility compared to holding a basket, say if you held the S&P 500 in an index fund. So we talk about diversification there. So some things to think about in planning is, what is your primary objective for the company equity and how will you use that in your financial plan? And again, what is your view of the stock? Do you have an exit strategy? And that's where I think you can work with a professional like a certified financial planner to help plan for the best way to execute exit strategies for these positions. And as you think about it in your role in the company and your outlook for the company, what's your job going to look like at that company? Are you thinking about leaving sooner, or do you think you're going to be promoted? So all those factors would weigh into your decision on how to handle that equity compensation. Another question I like is, if someone gave you $50,000, would you invest that in your company stock, or would you do something, invest that differently, or use that to fund maybe one-time goals? So all good planning questions to consider. There's a number of strategies you can employ to think about a disciplined exit, whether it be setting distinct price targets where you want to get out of the stock. You can do a time-based strategy, just picking specific times to sell the stock. It eliminates a lot of the emotion from the decision. You have a plan, stick with the plan, and also looking at doing a tax managed approach to it. So all good options to take into consideration. So as a wrap up, when it comes to selling company equity, some of the advantages are the liquidity that you get upon the sale, ability to diversify your proceeds, so you reduce the price exposure, and also you have control over the timing of the income. On the disadvantages, there's always taxes to be paid. So there are the immediate transaction costs. You may miss out on upside price participation. In some cases, you may need to disclose this if you're an insider in the company. So that's all I have for the content today. If you have questions, please send me an email at pnangle@marshallfinancial.com. am happy to answer educational questions, or if you would like additional information, look forward to hearing from you. I thank you for your time and look forward to seeing you at another webinar. Thank you.